Good evening, and welcome, ladies and gentlemen, faculty colleagues, students, alumni, guests, and friends of the college. On behalf of everyone here at Stonehill, I would like to begin by extending my very warm welcome to the President and CEO of the Federal Reserve Bank of Boston, Dr. Eric S. Rosengren. Eric, it is an honor to have you join us tonight and share your insights on the state of our nation's economy. The demands on your schedule and expertise are considerable, and I want you to know how much we appreciate you carving out time to come to our campus. I did it, I think. We have the event simulcast next door, and that was the sound of the video feed next door. So I thought I could hear myself for a second, but it just, so, okay, take two. Your visit Meehan School of Business building. Those of us who are fortunate to be based in the Meehan School work to create an academic environment with an intense focus on developing in our students the ability to think, act, and lead with intelligence and compassion. Giving them this opportunity to learn directly from someone with your experience in economics and in monetary policy is critical to our work. Again, you have our thanks and appreciation. Before turning the floor over to Eric, please allow me to give you a brief overview of his career. Eric is a voting member of FOMC, Federal Open Market Committee, the monetary policy body of the United States Central Bank. As CEO of the Federal Reserve Bank of Boston, he leads the Boston Fed's work on economic research and analysis, banking, supervision and financial stability efforts, community economic development activities, and a wide range of payments, technology, and finance initiatives. Appointed president in 2007, Eric has taken a rigorously data-driven approach to forming his views on the national and regional economy. His research and policy positions pay close attention to both aspects of the Fed's dual mandate, labor market outcomes, and as well as price stability. His work as a researcher and now as a policymaker has often focused on issues related to financial stability and its impact on the Main Street economy. He has led several efforts to expand the Boston Fed's outreach and impact on low and moderate income communities, hosting foreclosure prevention workshops for New England residents during the Great Recession, and running a competition for post-industrial New England communities to develop cross-sector collaboration to ultimately help improve the lives of lower-income residents. Eric holds a bachelor's degree in economics from Colby College, where he is the current chair of the Board of Trustees. He earned master's and doctorate degrees in economics from the University of Wisconsin in Madison. Before I introduce Eric here and welcome him to the podium, ladies and gentlemen, one housekeeping thing. Please make sure your cell phones are turned off as we speak. When I go to class, I tell my students, the only chance you have to touch your phone in my class is on day one when I tell them, turn it off and put it away. Please put them away. Ladies and gentlemen, Dr. Eric Rosengren.
Thank you very much. Thank you very much. Can everybody hear me fine in the back? Sounds pretty good. And thank you for addressing that echo issue before I came on the stage. It's a pleasure to be here at Stonehill, and congratulations to the school for opening up the new Meehan building. We were just over there prior to me coming over here. It really is a fantastic facility. We were looking at all the Bloomberg terminals, and it really is quite a tribute to the school that they've been able to build such a nice building. So congratulations on that, and congratulations to everybody who's going to get to take advantage of that. So today I'm going to talk a little bit about what's happening in the economy. And it's been a pretty eventful August. So while many of the students were having some time off, hopefully, and enjoying the summer, summer hasn't been such a great break if you're somebody who actually follows financial markets. So you can see from this list, we had right after the last FOMC meeting, which occurred at the end of July, there was an announcement that were likely to be tariffs. Those tariffs were to go into effect at first, all at September 1st, and then they were staggered between September 1st and December 15th. At the same time, we've had a Treasury 10-year rate that's dropped down to very low levels. We're down to roughly 1.5%, much lower than where we were just a year ago, more than half of where we were a year ago. So that's a pretty dramatic change in the 10-year bond rate. We've certainly seen a lot of volatility in stock prices. We had an 800-point decline in August. We've had a lot of volatility. Now, after that decline, it did start to come back. So it is volatile, but we're actually only 2 to 3% off the peaks that we were seeing earlier in the year. So despite the volatility, we're still at pretty high levels. And so we're going to be expecting a fair amount of financial volatility to continue, as was exhibited today as people became concerned once again about tariffs, and we saw some more declines today. Interestingly, the economic data has not been nearly as volatile or as exciting as the financial data. So the economy grew at 2% in the second quarter. That's actually pretty good growth. So our estimate at the Federal Reserve Bank of Boston of what the economy can grow over the long period of time would be 1.75%. So we're actually a little bit faster than the potential growth of the economy overall. So that isn't bad growth. Now, it's certainly not the 3% growth that we were seeing before, but it's still growth that's strong enough that it should tighten up labor markets. So that's not a particularly bad outcome. Forecasters expect that 2% growth to continue over the course of the next 2 quarters. So how is it, with the concern about tariffs, the concern about business fixed investment, that we get growth around 2%? And the answer is that consumption's been really strong, and I'll show you some charts on that. But consumption, buying goods and services, is 70% of the economy. So if the consumer's doing really well, the economy doesn't do so poorly, even when business fixed investment and net exports aren't nearly as strong. And that's exactly what we've seen in the pattern. The unemployment rate, I was having an interview with a student right before coming over here. She's about to go into the labor market starting at Christmas, and the unemployment rate's at 3.7%. That's still a really low unemployment rate by historical standards. I have a lot of businesses that come into my office and talk about what economic conditions are like. And while they do frequently talk about tariff concerns, the biggest concern they actually talk about is being able to fill the jobs. And that's not just high-end IT jobs, that's restaurants, that's a variety of different employers come in and say it's very difficult to hire the kind of skilled labor that we want. It's a great time to be coming out for those of you who are seniors, so hopefully that economy continues to be strong. Forecasters expect the unemployment rate to stay about at the levels that they currently are. They actually expect it to go down by 0.1% to 3.6%. And in terms of inflation, we're around 2%. The core PCE inflation's a little bit soft. It's only at 1.6%. So the core inflation is taking out things like food and energy that are very volatile. And the reason we do that is because oil prices, for example, have come down quite a bit very recently. And so it's so volatile that we kind of look at, we want to get the underlying rate of inflation. We don't want to focus on change in goods and service price of just a couple items. So one way to do that is to look at the core item. The other way to do that is the Dallas Trimmed Mean, which takes out kind of the outlier observations. And the goal is that there are lots of things that can change, particularly at a time when you're having tariffs. So it kind of looks at the bulk of goods, not at the tails of the distribution. When you do that, it's actually, the inflation rate's right around 2%. So why is there this dichotomy? We have a stock market that's been very volatile, but we have economic forecasts that are pretty boring. basically growth around 2%. And obviously, one of the reasons that's driving that is the trade and geopolitical concerns, which still remain quite elevated. So tariffs are a tax on imports, and so not surprisingly, both the tax on imports as well as the retaliatory tariffs by China are not particularly good, particularly if you're a firm that engages in international trade. So that is a problem for corporate earnings for those firms that are directly affected by the tariffs or the retaliation to the tariffs. So it's not surprising that whenever we hear stories about whether the negotiations are going well or the negotiations are going poorly, the stock market reacts, because corporate earnings are likely to be affected, particularly if you're a trade-related firm. So when we see lower earnings, we would expect lower asset valuations. Probably as troubling as what's been happening with the tariffs, it's what's happening with the global economy. So the Chinese economy was already slowing down even before the tariffs started to come into place. So it's the second largest economy in the world. It is a big deal if China ends up slowing down. They're obviously facing other kinds of political concerns, seeing the riots in Hong Kong. Hong Kong's one of the world's great international cities. It's certainly a problem if that city continues to have the kind of unrest that it's had. And there are many other countries that are both dependent on foreign trade, but are also facing difficulties. And the obvious one is the UK, with the possibility that we have Brexit at the end of October. So the context is that we have these trade concerns at the same time that there are a lot of reasons to be concerned about the global economy. Adding to that has been some of the financial market warning signs. And one of the warning signs that financial markets pay a fair amount of attention to is the difference between the 10-year Treasury bond and shorter-term yields. So that's referred to by economists as the yield curve. Now, the idea there is fairly simple, which is if I'm going to put my money away for 10 years, I want to be compensated for that. So normally, I get a higher rate for a 10-year bond than I get for a 3-month bond because I'm asked to lock that money up. It's also that because you're locking that money up and it's giving a constant dividend, the price volatility of that other instrument's greater as well. So for both of those reasons, normally I would expect long-term rates to be higher than short-term rates. And in fact, that's what we normally see. But right now, that's not the case. It's called an inverted yield curve, which is the 10-year bond, which is trading a little bit below 1.5% right now. And if you look at the very short end of the financial market, the Federal Reserve's the federal funds rate, which is the rate that we target, is at 2.13%. So it's higher than the 10-year bond. So we have an inverted yield curve. Now, the reason people pay attention to that is that it has tended to precede recessions. So that is a sign that people are worried about what's going on. But I would argue that that historical correlation of an inverted yield curve right before recessions may not be so applicable at this time. The reason for that is partly because of the global conditions that we're facing right now. So if you look at interest rates in Japan or Europe, not only are there short-term interest rates at zero, but before we came in, we were looking at the Bloomberg terminal. A 10-year German bond is currently negative 0.7%. So they have basically no positive interest rates across the yield curve, and no matter how far out you go on the yield curve in some of these countries, it's actually a negative yield. Dramatically different than what we're finding in the United States. That tends to depress yields in the United States. So I think it's primarily reflecting weakness in other countries, but it's also that other financial market data are not indicating that a recession's likely. So one of the things we would expect if there was going to be a recession is that people become more worried in the stock market. So earnings don't do very well, corporate earnings don't do very well in the middle of a recession. So if you really thought a recession was imminent, you'd be worried about the stock prices, and you'd start seeing stock prices decline. Stock prices are within 2 to 3% of their peaks, so we haven't seen that yet. Now, some people would argue that the people that invest in the stock market are very different than the people that invest in the bond market. And when they're listening to the stock market or the bond market, they rely on the bond market. Even if you believe that, one of the things you would expect if there was a recession is that you'd see credit spreads widen. So if you think about a corporate bond, versus a US government bond, there's a lot less risk for the US government bond. If you're worried about a recession, you're going to need a higher return in order to buy that corporate bond. So you'd expect yield spreads to widen. That's what we're not seeing. We're not seeing that widening occur. So the financial markets are showing kind of a mixed message, and I don't take nearly as much information from the fact that we have an inverted yield curve as some of my colleagues. So when we think about what the policy ought to be in this kind of context, what are we weighing? Well, right now the US economy and most forecasts of the US economy by people that are taking into account both the trade concerns and what's happening with business fixed investment come up with a growth rate around 2%, which is to say they're not seeing a recession, they're seeing growth pretty much like what we were seeing in the second quarter. If you look at some of the financial market data, particularly looking at the inverted yield curve, you may be much more concerned. So we have to decide which of these signals we ought to be paying more attention to. And I would argue that this is a time where we really, in the opening comments, we talked about data dependent. I actually think this is a time we really have to be data dependent. There are two aspects that are really important. One is, does the consumer continue to spend? So that is a critically important issue. And do we continue to see strong growth in employment? As long as we're seeing consumption and employment being relatively healthy, I'm not nearly as worried. But there certainly are some pronounced risks, and they do threaten the US economy. Tariffs are certainly one of them. The global slowdown is another. Those kind of headwinds could become more appreciable. If they do and they start slowing down the economy, I think we should react once we see it in the data. But I don't think we should anticipate necessarily that that's going to happen. So as long as we're growing around 2%, I don't see nearly as much of a need for taking immediate policy action. So I'm now going to show you a bunch of charts. I've given you a layout of what I'm going to say, but now I want you to see some charts so that you can visualize it a little bit better. So this first chart is just looking at the growth in the economy in real terms. So as the goods and services growth in the US economy, you can see in the first quarter we grew a little bit faster than 3%. In the second quarter we grew exactly at 2%. The blue chip consensus, which is a forecast, not actual data, is the data to the right in kind of the, I don't know, grayish color. And you can see that basically the private forecasters, this is roughly 50 private forecasts. This isn't my forecast, this is private forecasters' forecast. And you can see on average, they're expecting the growth over the course of the next year to be around 2%. So 2% isn't particularly bad growth. How is that happening? It's because consumption has been so strong. So in the second quarter, consumption grew at 4.7%. So how do you get 2% growth overall when consumption's that strong? It's because of those negative lines. So business fixed investment was weak, so was exports. So the composition in the economy was that sectors that are really affected by global trade, that are really affected by a global slowdown, like business fixed investment and exports, were quite weak, but the consumer remained quite strong. So one of the big questions going forward, is this pattern going to continue? So the way that the private forecasters get 2% growth over the next year is basically they're assuming that consumption's going to hold up. Now there's a good reason to believe that at least going into the third quarter, that's not a bad projection. So this looks at retail sales and looks at April, May, and June. So that growth rate in April, May, and June, those three rectangles represent that 4.7% GDP growth that we were seeing in consumption in the second quarter. And what you can see is the July number was really strong. So that's a good sign. One of the 3 months in the third quarter already was quite strong. So most forecasters are expecting that what we've seen in consumption in the second quarter will be continuing into the third quarter. But it does depend on consumer sentiment staying reasonably strong. So the reasons to expect that the consumer is going to continue to be reasonably happy with how the economy is going on. Payroll employment's been pretty strong. The unemployment rate is quite low. Stock market is pretty high. Personal income is quite high. Those would be all the things that we'd normally put into how we estimate consumption and what consumption is going to be over the course of the next year. So all those aspects are quite strong. But consumer sentiment is something that is important. People become worried that we're going to go into a recession. They pull back just like a firm pulls back. And if that becomes widespread, then it does become a problem for the economy. You can see that the most recent number, this is from the Michigan survey, was a little bit weaker. It's not dramatically weaker than what we've been seeing over the course of the last 3 years, but it was a negative reading. Now, there are other measures of consumer sentiment or equivalent indices that don't show that same negative move. But that's certainly one reason why we have to watch very carefully what the consumer's doing, because if the stock market declines or people become concerned enough about the foreign trade, then that's a situation where we might worry that consumption would get much weaker. At that point, then I'd become much more concerned about what the outcome will be for the economy overall. So the second component I want to talk a little bit about is exports. So obviously with the tariff discussion, there's a lot of discussion about what's happening with foreign trade, what's happening with the tariff tax that's been slowly and gradually increasing. And this shows you the exports as a share of GDP. So it says how important is it to export goods to other countries for each of these particular economies. You can see for the United States, it's only 12%, which is to say we don't export a huge amount. We do export, but relative to many other countries, our exports are much less. So when we have a tariff issue and trade problems, it's a big deal if you're at the left side of that chart, because that means that a lot of your economy is dependent on the global economy and is really dependent on an environment where you can export. If you're to the far right, it's not that it's not a concern, but it's not nearly as big a concern. So you can see that China isn't quite double what the United States is. And when you get to a country like South Korea or Germany, those are countries that are very, very dependent on global trade. So it's much more important for those countries, not to say that it doesn't matter for the United States, but it certainly doesn't matter as much. One of the reasons you might be concerned, not only, this is basically a bilateral problem between the United States and China, but Germany and Italy not only trade with the United States, but they also trade with China. So if China slows down, it's a problem for Europe. So for these countries to the far left, it is a big deal what happens with what we're doing with our trade agreements and whether the economy slows down overall. So the data and forecasts are consistent with growth slightly above potential. So it is telling a somewhat more positive story. Growth around 2%, consumer is key to the outlook, and forecasts already include weaker business fixed investment and exports. So despite the concerns about trade and geopolitical concerns, it's a pretty good outlook, but there are definitely risks. One of those risks are the risks that people get very concerned about what's happening in financial markets. So let me turn for a minute and just talk about the financial markets. So on this chart, I show two different kinds of securities. One is a 10-year Treasury bond, which is the dark brown, and the other is a 3-month Treasury bill. It's just meant to be a short-term security, and that's in green. Now, I said that normally, in order to buy a 10-year bond, I want to get a higher return. Just think of when you go to the bank and ask for a CD, and if you ask for a 3-month CD, you don't get nearly as good a rate as if you ask for a 1-year CD. Same basic idea here, but we're looking at the Treasury yield curve. And you can see most of the time the brown line is above the green line. But you can also see there are a few times where the green line's above the brown line. And in fact, those times tend to appear right before that shaded period, which is recessions. So the reason people have been concerned is that there is this correlation that around previous periods, when we've seen an inverted yield curve, we have had a recession. Now, one of the reasons for getting an inverted yield curve is that the Federal Reserve becomes concerned with inflation, and we start raising short-term interest rates because we're thinking that inflation will get out of control. That's not the case right now. In fact, I told you that inflation was actually low. Core inflation's 1.6%, our target's 2%. So right now it isn't a problem that inflation is particularly low or particularly high. It's actually a little bit lower than we'd want. So this isn't a time where the Fed is trying to tighten up on the economy. Another aspect is that the long bond has come down rather than the short rate has come up so much. And I think that reflects one of two things. One story would be internationally, when you have a rate that in Germany is so low, there's a natural arbitrage between a German 10-year rate and a US Treasury that's a 10-year rate. And so if the Germans really push their yields down very low, it's going to have an effect on US markets as well. And in fact, we do see that at times when the German bond drops significantly, it tends to have an impact on US rates. So that would be more of a global conditions, something that we'd already incorporate into our forecasts. A second aspect of this, though, wouldn't be quite as positive. And that would be if you're worried we're going to go into a recession, one of the things you do is you move into 10-year treasuries. The reason for that is because when rates go down, the price goes up. So if you're worried about a recession, if you move your funds from stocks to bonds, and you're buying 10-year treasury bonds, and everybody does the same thing at the same time that you do, more and more people buying those bonds, it's going to push the rates down and push the price up. So it's a natural hedge against a recession. So if you're looking at bond prices, they do tend to go up in recessions. So we observe that the 10-year rate has come down. We don't observe exactly why it's come down. And so that's part of the debate right now, is trying to understand that. Now you have to put it in the context of what's happening with monetary policy worldwide. So this shows you the short-term rate that is in the United States, which is in dark brown, Japan, which is green, and the Euro area, that's gray. So if you look to the right, the only rate that is positive right now is in the United States. That's the federal funds rate. So one of the reasons our rates are higher than in other countries is our economy is doing better than other countries. Germany had negative GDP. Japan's had a weak economy for some time. Their monetary policies tried to address it. How did they address it? Well, they kept rates down at zero. So we brought our rates up because our economy is doing better. They don't have that flexibility. Their short-term rates are already as low as they can get. So if you're in Japan or Europe, what do you do when you're having negative shocks, but monetary policy in your country at the short end can't react? And the answer is you start pushing down long-term rates. And you can see here that both in Japan and Germany, they've really pushed their long-term rates incredibly low. And you can see as the German rate tends to go down, so does the US rate, which reflects, think of yourself as a pension fund or an insurance company in Germany, and you're looking at a 10-year bond that's paying minus 0.7%. And you say, well, the US rate isn't great, but it's 1.5%. Positive 1.5% is better than minus 0.7%. Now I have exchange rate risk, so it's not a riskless transaction, but I probably would prefer to get a positive return. And so as a result, you do see more foreign institutions and individuals buying into the US market. And I think that's what this chart is intended to show. Now, if you thought that was instead a signal of the economy doing much worse, this shows you what's been happening with the stock market. And I just used the Dow Jones Industrial and the S&P 500. This is indexed at the beginning of January 2016 being 100. So it's just an index number. It doesn't correlate to the actual index value. But what you can see is the stock market's roughly 50% higher since January of 2016. That's a pretty big increase over a relatively short period of time. And in fact, while we're a little bit off the peak, it's only a little bit off the peak. It's 2 to 3% less than that peak to the far right. And when you take it in the context of the 3-year history, you can see that the stock market is continuing to do pretty well. So the stock market isn't really flashing a concern that we're immediately going to have a recession. I would say that we are getting a lot of volatility, so that is something that you have to be concerned about, but certainly the levels are not particularly concerning at this time. This chart shows you the difference between a corporate bond, that's at the low end of the investment grade spectrum, and a treasury bond. And you can see those spreads tend to get really wide during a recession. And the reason is because people start worrying that bonds will be defaulted on by corporations. So if you're worried that your bond might default, you're going to demand a higher rate. So you're going to see the spread widen during recessions when it's more likely that you'll default on a bond. So one of the indicators of a recession would be a widening in the corporate bond rate relative to the 10-year Treasury rate. That's not what we're seeing right now. So the bond market right now is literally right at the mean that we've seen over this period since 1988, so it's not particularly elevated. So the financial market indicators, they are a little difficult to disentangle. We are seeing weakness in foreign economies, and they don't really have very much policy space, which is forcing them to push down their long-term yields. Ideally, you'd see more fiscal policy in these countries rather than monetary policy. It's very hard to stimulate an economy when your rates across the entire spectrum are already at zero. So ideally, they'd be using a different mix when they're choosing, but they're not choosing that. And the monetary authority is trying to meet their mandate that's provided in Europe, which is really focused on inflation. We do have to worry about whether they're hedging concerns, but the fact that the stock market and credit spreads don't seem particularly elevated makes me at least a little less concerned about that signal. So I think it's really important for us to watch very closely the risks that could potentially materialize, but I don't think they've materialized yet. In terms of inflation, this shows you the trim mean PCE, which is just taking out those outliers, and the core PCE, which is taking out food and energy prices. And then the dashed line is the 2% target that the Federal Reserve has for inflation. And you can see that we're a little bit low on the green. We're right where we want to be on the brown, and we're pretty close to 2%. My expectation is that we will see the core PCE continue to go up, particularly because over the last 3 or 4 months, we've actually had pretty strong inflation numbers. Labor markets are still pretty tight, and we're about to get a bunch of supply shocks from the various tariffs going into place. So that combination makes me pretty confident that we're probably not going to have a problem with inflation being too low. The other reason I'm not so concerned about inflation is because we're actually seeing wages go up. So you can frequently read that wages aren't going up, they're stagnating. They're not going up as rapidly as people would like, but they're not flat. They actually have been going up, they have been going up slowly. So if you look to the far right, this is 2 different ways of measuring wages and salaries. One is average hourly earnings, which comes out with the employment report. The second is the employment cost index, and I'm taking out occupations where you get big bonuses at the end of the year, because that can be a very noisy series. And you can see that we have been gradually, as the labor market's tightened, you are seeing wages going up over this period. We're roughly at 3% for wages. That's about right. So the way you should be thinking about wages is you want to be compensated for inflation, which is roughly 2%, and you want to get compensated for improvements in productivity, which is running about 1%. So a wage rate around 3% is back of the envelope right. Now, if that wage growth continues to go up and we don't see more productivity, over time, that means firms are going to be faced with an issue of either raising prices or having their profit margins squeezed. But at least at the current rate that we have for wages and salaries, it's actually growing at about an appropriate rate. So concluding observations, there are definitely things to be concerned about. Tariffs and geopolitical uncertainty have definitely increased, and they've definitely increased in the last month. So the risks are elevated. If they become a reality and it really does slow down the US economy, then I think we do have to respond aggressively, keeping in mind that short-term rates are only at 2%, so responding aggressively means the Fed tends to move in 25 basis points or a quarter percentage point move at a particular meeting. We can do more, but it tends to be 25 basis points. Means that we only have 8 clicks down before we hit 0. So there is limited space, so we have to be mindful of that. But to date, the economic data and the forecasts are pretty benign, so I don't want to use up that valuable space at a time where we actually think prices are pretty stable and the labor markets are pretty tight. So I'll stop there, and I'd be glad to take any questions that people have. It looks like we have 2 mics up here, and I'd be glad to take those questions.
Thank you very much, Eric. What we had done was asked our students to submit questions. So they have submitted questions. I'm going to call on them to individually ask you of those questions. And my money and banking students must have been, just really quite delighted to hear about monetary policy from the best. Our first question is from Thomas Brennan. Thomas, are you nearby?
Hi, thank you for talking to us this afternoon. My question is in regards...
Speak into the mic so everybody can hear.
My question is in regards to the Phillips curve, or the relationship between unemployment and inflation. You mentioned how they're both relatively low, whereas in the past one's high and one is low. Could you give us some insight as to why that is?
Sure. So one of the Phillips curve is just a relationship, as he described, between inflation and unemployment. And so one of the ways that the economy works is as the labor market gets very tight, wages and prices start to go up. And so we see a correlation between very low unemployment rates and periods where inflation are going to be a bit higher. This relationship is not nearly as strong as it was before. So a lot of the power from this relationship came from the 1970s. If you can remember, most of you probably don't remember the 1970s, but if you looked at a chart of the 1970s, you would see that oil prices were going up very rapidly, inflation was picking up, and at that time, labor markets were quite tight, inflation was very rapid, so that's where some of the power of this relationship's occurring. Now, since the mid-90s, both in the United States and globally, we haven't seen nearly as much inflation. So the argument is that we have well-anchored inflation expectations, which is to say that central banks have said they're aiming for 2%, and people believe them. So even when labor markets get a little bit tight, we have a situation where people are expecting 2% inflation to continue, and so you'd get something like that wage chart that I had, which is 3%. Now, if we really push too hard, there's an open argument about what would happen at that point. So if we push the unemployment rate down to 3%, which we haven't seen for a very long time, you might see a lot more inflationary pressures at that point. But around the area that we think is relatively close to full employment, you wouldn't expect to see a dramatic move as long as people's expectations are that we'll be around 2%. That's what we're actually seeing, and that's actually good news, because that gives the Federal Reserve a lot more flexibility to react to positive or negative shocks without being too worried that inflation becomes unhinged.
Great, thank you. Our second question is from Thomas Kunz, another money and banking student.
So my question was, if the Federal Reserve is trying to account for some recessional headwinds, does the FOMC have any room in terms of basis points or the clicks downwards that you just referenced to make adjustments in the future?
So we do have room, as I mentioned, the federal funds rate's at 2%. The 10-year bond right now is roughly at 1.5%. So our preferred tool is actually to move with short-term rates, ideally. The reason for that is because short-term rates are what our traditional mechanism is for affecting the economy. So we have a lot of historical relationships looking at what happens when we raise or lower interest rates. So at 200 basis points, we have roughly 8 moves at the short end of the market. If we hit 0, do we still have monetary policies that we can do? And the answer is yes. We can start buying long-term securities. The purpose of buying long-term securities is to flatten that yield curve and push long-term rates down. But this time we're at 1.5%. Last time we were at a much higher rate. So there's a limit to how much we're going to be able to push long-term rates, particularly at a time when the rest of the world is relatively weak and doesn't have much monetary policy space. If we get to that point, it will be appropriate to use fiscal policy. If there's no cost for the government to borrow money, they probably should be using a more expansionary fiscal policy. That's what Germany and countries like that should probably be doing right now.
Thank you. Sophia has our next question.
Many individuals, especially in marginalized communities, do not participate in the financial system. This limits their access to essential financial services and their ability to accumulate wealth. How can the Fed use its authority and influence to make financial markets more inclusive?
So inclusivity is really important. I would say that the tools that we have are not the ideal tools to try to deal with inclusivity. It really is fiscal policy that does more. But I would say there are other things that we do to try to address inclusivity. One of the things is the Federal Reserve is responsible for the payment system. And we've just recently announced, actually, that we're going to start providing immediately available funds, a real-time gross settlement. Think of it in terms of many people cash their checks right now by going to a check cashing place rather than to a bank. If instead we have a system that enables you to get your funds in real time, so you could get paid daily, you could get paid weekly, you don't have to wait until you get a check at the end of the month or every 2 weeks, but can instead get your funds immediately. That would take care of some of the people that are currently unbanked because they'd have much more access to their funds. So there is some things that we do that impact low-income families. I would say the other thing that we do is that we have a whole group at the Boston Fed focused on low and moderate income individuals. We're focused on rural communities in Vermont and Maine. We're focused on cities that tend to be quite diverse in many of our smaller cities around Massachusetts, Rhode Island, and Connecticut. And so we've been holding competitions trying to get them to grow much faster than they have historically. So if you look at what's been happening at our mid-sized cities, think of Fall River, think of Lawrence, think of communities like that, they have been falling behind the rest of the country. So we're actively trying to find ways to try to encourage more collaboration in those communities. It was mentioned at the outset. But if you're interested in that, if you type in working cities and take a look at the Fed's website, there's a lot more description of what we're doing in this area.
Thank you.
Super. Our next question is from James.
Facebook is planning to launch the Libra digital currency in 2020.
Could you turn up the mic? Because you're tall and the mic's low.
James is on the tall side. So
How will the introduction of the Libra and other alternative electronic currencies affect the Fed's ability to implement monetary policy? And in addition, should users be concerned about how firms that issue private currencies balance the interests of users and shareholders?
So the cryptocurrencies, of which Libra is one of the possible cryptocurrencies, one of the big challenges is, one of the big attractions is that you don't actually document the transaction. So it's a little bit like your currency. There's a reason why people like to get paid in cash. And the reason they like to get paid in cash is it's an anonymous transaction, and you could argue whether or not that appears on some people's taxes, for example. We have various rules for bank accounts that focus on trying to prevent money laundering and prevent illicit use of funds. These cryptocurrencies, in effect, get around that, which is exactly why the federal government's not as comfortable with some of the cryptocurrencies. So we want people to continue to pay taxes, and doing large transactions anonymously pose a concern, both in terms of terrorist funding, drug funding, other kinds of funding for illicit means. So one of the challenges is, one of the big advantages of the cryptocurrencies is also one of the big disadvantages, which is that you can't trace the funds, and that can be important when you're talking about large denomination fund transfers. So my guess is in the immediate future, we're not going to see broad acceptance of this, in part because they have the Bank Secrecy Act and anti-money laundering regulations that actually make it hard for it to completely catch on. I would also say that in other countries, their central banks are beginning to think about alternatives to cash, and certainly, while I don't think we're going to have a cryptocurrency, the distributed ledger technology actually is pretty useful. It's a technology that probably can be applied in a lot of other things other than Bitcoin and cryptocurrency. So it's something that we're certainly watching, but we also are concerned about the side effect of making sure that transactions aren't being done primarily for illicit means.
Thank you.
super. Thank you. Our next question is from Liam.
So it seems that stocks have taken a major hit in the last few weeks due to uncertainty from our trade disputes. Can the Fed use communication policy to offset some of these headwinds?
So communication policy, I didn't talk much about communication policy, but actually it's become much more important for central banking. So I would just highlight that we're doing a lot more communication than we used to do. So all the Fed presidents and governors do these kind of speeches. After every FOMC meeting, we have minutes and statements that come out. The chair then does a press conference. Shortly, a week or two later, we get minutes, and 4 years later, we get a complete verbatim transcript. So we've become much more transparent. When I first started at the Fed, we didn't even announce when we changed interest rates. So it's a quantum change from where we were before. We're a much more open organization. I would say that it is really important for us to be able to communicate with the public at large in a much better way than we have before. So the communication skills have become a trait that wasn't all that important for a central banker before. Anybody who listened to Chairman Greenspan or Chairman Volcker, they went out of their way to make sure that they were obscure. That's no longer the goal. So if you look at the last couple of chairs, they've been much more effective at trying to talk to people so that people can understand what the policy is. And one of the reasons why that's so important is because there is behavioral economics going on whenever we're making an action. And so we care about how financial markets react, but we also care about how everybody in this audience reacts. That's not all that easy for us to determine, but we're getting better and better both at the communication, but also thinking about how our communication affects behaviors over time.
Super, thank you. Our next question is from Abby.
It appears that Britain may make a hard Brexit in less than 2 months. How will this affect the United States, and how will the Fed behave to mitigate any harm to the U.S. economy?
So it is a possibility of having a hard Brexit. It's actually a little bit hard to believe that that is something that a country would voluntarily do at this stage, but it does look like it is a real possibility. So the biggest impact won't be on the US, it'll be on the citizens of the UK. They're going to be the ones that are most affected. In fact, they're already being affected. So when you talk to financial firms, there are a lot of big US firms, including US firms that are in New England that are also in London. Most of them have already diversified and have a lot more operations in continental Europe than they did before. Other firms are also thinking about moving to the continent where it's going to be a much bigger market. So it could be disruptive. It's particularly going to be disruptive for the UK and to some extent also to Europe more generally. So my slide of exports highlighted that Germany and Italy are big exporting countries. One of the places they export to is the UK. And Germany and Italy are already in a pretty weak state, so the GDP has not been growing rapidly in those countries. So it is a problem to have a negative shock like a Brexit shock. And in the short run, it could be pretty disruptive. You could imagine trucks being held up while they try to get customs set up. And there are concerns about how smoothly this process would work. So I think the real concerns, I think it'll be primarily European concerns. To the extent that it starts to affect financial markets, that's where we'd get more affected. So, I mean, we do some trade with the UK, but to be honest, it's a small enough country that country by itself, even if it gets weakened by Brexit, probably doesn't affect the US economy dramatically. But if it becomes more of a global concern, then that's something that we'd have to watch out for and be more concerned about.
Thank you. The next question is from Tony.
As you have mentioned, the yield curve is currently inverted. My question pertains to the U.S. Treasury Department, and they're considering the issuing of 50 and 100-year bonds. What are the downside and upside risks to the national debt and U.S. economy if the Treasury was to follow through with this plan?
So if you're a pension fund, you have long-term assets and liabilities, and right now, the longest Treasury security that's issued is a 30-year Treasury security. So there are reasons why you might expect that there are at least some investors that would want longer duration securities. So one of the reasons why the Treasury is thinking about that is they think there might be some demand from investors. I think the other reason is that rates are quite low, and they want to, given that we've been running pretty large deficits, and this is fiscal deficits, not trade deficits, fairly large fiscal deficits, that if you were in charge of debt management, you can reduce some of the risk over time if you get very low rates for a very long period of time. Now, one of the challenges with that is one of the things monetary policy does when short-term rates hit zero is then we start buying long-term securities to push those rates down. If you start issuing a lot of long-term securities and there's not a huge amount of demand, those rates will actually be in real terms pretty high. So the Treasury is now trying to get an assessment of at what cost would it be to issue it, and is it worth the risk to the Treasury of actually doing it. I don't know what they're going to decide. The Federal Reserve's not involved in that decision. It's a Treasury decision.
Thank you.
As the moderator here, I guess I can cut the line and just ask a question before the next student. Since my question was related to this, with the potential issuance of 50, 100-year U.S. bonds, the impact is going to be equivalent or similar to a quantitative tightening, where currently the policy is suggesting quantitative easing. And I can't wrap my head around this, just try to figure out the appearing to be two contradictory type of things. I understand if you do that, it's sensible for the U.S. Treasury to borrow long-term at a time that rates are low. But I also am mindful of the fact that if they begin issuing 50, 100-year duration bonds, then they're going to result in pushing long-term interest rates up. And should we worry about that?
Yeah, so that's exactly right. Issuing a lot of long-term securities would have the effect of, and when they made the announcement, there was actually a steepening of the yield curve. It wasn't dramatic, but it was noticeable that it actually did. I think it depends on whether you think the Treasury's primary goal is to minimize the costs of financing the deficit, or do you think that the goal of the Treasury ought to be similar to the Fed's, which is making sure that we have maximum employment consistent with price stability? If you think the latter, then you wouldn't be that inclined to issue these very long-term securities. If you think the former, you might be more inclined to do it. So it depends on what you think the role of the Treasury debt management is. I personally share your view that it would be like a quantitative tightening.
Thank you. Our next question is from Carter.
So looking toward the long term, we can see that climate change is going to have a drastic effect on the planet. So how do you think in what ways do you think that will affect the U.S. Business cycle, and how will the Federal Reserve conduct monetary policy in that type of environment?
So monetary policy tends to have a much shorter duration in terms of the policies that we're trying to affect. We're lucky if we can forecast out reasonably 2 years. There's pretty big errors around even forecasting out 2 years. Hopefully climate change is gradual, and it is something that you're not going to address by moving interest rates. So the direct effect that the Fed's going to have is pretty minimal, but I would say that it is something that we're spending more time thinking about. So think about coastal areas that might be flooded. How easy is it going to be to get flood insurance if you continually have more floods in certain areas of the United States? If you look at where a lot of the production in the United States is, it's along the coasts, it's along rivers. There's a historical reason why cities were located near rivers and oceans, because that was a low-cost way of transporting goods. So it was a real benefit at one time. Obviously, if we have climate change that's significant, that's going to be a problem for many of our cities, and it's going to be very expensive to address. Think about Boston. Boston is a harbor. If you were from my building, we were looking over at the seaport area. It's a beautiful area, but it flooded during the middle of the winter. And if we really had a significant change in water levels, there'd be many areas of Boston that were affected. Cities are thinking about that. Businesses are thinking about it. Actually, if you look at the seaport, they've designed the buildings for flooding. But a disadvantage is you don't really get compensated for building a building designed to take care of flooding. And if the flooding occurs regularly, at some point it becomes prohibitive to get insurance. If you can't get insurance, you're going to start questioning whether you want to be in a location that floods a lot. So I think there could be some pretty big disruptions. I did mention that productivity is an important part of wage compensation. If we have to spend a lot of money on remediation, it's less likely we're going to be as productive an economy while we're spending resources on things to address climate concerns. So we do think about it. We are concerned about it. It's not something we're going to address by changing interest rates in the short run, but it's certainly something that we have to think about in terms of affecting patterns in the economy over the long run.
Our next question, thank you, Eric, is from Lucas.
Thank you very much for your time so far. My question to you would be, do you have any concerns with lowering interest rates that will potentially allow the expansion of the trade war in the future?
So when I think about why we're doing interest rates, it's really focused on our dual mandate, focused on what's going to be the impact on inflation and unemployment. So we don't really spend a lot of time thinking about political concerns. That's really not our job to be thinking about that. Our job's really to be kind of technicians and say, okay, this is what we expect to happen in the economy. Is this an economy that's weak enough that we have to be more accommodative, or is this an economy so strong that we have to take back some of that accommodation? So we actually, in the FOMC room, there's really no discussion of political concerns.
Thank you.
All right, our next question is from one of our econ professors, Professor Alex Eierman.
So I would like to refer to that chart with PCE and trim mean inflation.
Yep.
When you look at the last decade, going back to the Great Recession, you can see that substantially more often than not, inflation was below 2% than it was above. And thinking about the FOMC's last statement, I think symmetric inflation target popped up 3, 4, 5 times. So clearly, the Fed would like a symmetric target, but it looks like in the data that so far it has been asymmetric. So can you talk about the challenges the Fed has had in making sure inflation stays at 2%? And is the Fed concerned that if it does not, if we don't have a balance, that all of a sudden inflation expectations might fall into the future to some number below 2%?
So that definitely is a concern. As you pointed out, if you take the average since the great financial crisis, we have pretty consistently been below 2%. Now, we haven't been dramatically below 2%, and we do have a dual mandate, so we have to weigh how much we're missing on inflation with how much we're missing on the labor market and unemployment. So right now, we're in an environment where the estimate of the committee for full employment is around 4.2%. The unemployment rate's at 3.7%, so labor markets are actually a little tighter than we would expect. If we look at inflation, and let's use the core PCE at 1.6, it's a little bit below 2%. And we have a balanced approach, which is labor markets are pretty tight, inflation's a little bit lower. So we have to balance those off. That being said, we have to be concerned if we're consistently missing on our 2% inflation target and ask why. Now, I would say it's a global problem. It's not particularly unique to the United States. And in fact, Japan and Europe that actually have an inflation target with no employment mandate have a bigger problem, which is why they've pushed their long-term rates so low, is that their equivalent to Congress has told them they should hit 2% inflation. And so they're trying to make monetary policy more and more accommodative to force that to happen. We're fortunately not in that position. I'm more confident than some of my colleagues that we're actually going to get back up to 2%. I think the data that we've been getting over the last 3 or 4 months is pretty consistent with that.
Thank you.
Thank you very much, Eric. Thank you, everyone, for coming to this event. I just wanted to thank you for your graciousness and your entire staff at Federal Reserve Bank of Boston. These guys have been around here for days nonstop, working nonstop to make this happen. I want to thank all of our faculty, staff, just Martin McGovern and his team, our IT and AV people, for their help and the support of the institution for making this happen. Thank you again, Eric.